Chad, today's an exciting day. You know why?
Why is that, Jared?
Today it's episode 26. Technically our 27th episode if you consider the 0 episode, but 0 and 1 came out on the same day, which means that we are halfway at the halfway mark for every Friday, Focus Friday, for our first year of our podcast.
That went pretty fast, actually.
It went super fast. I think that, time flies when you're having fun and educating. But
always have the jokes.
Yeah, always have the jokes. I mean, you're the dad here, but I try to hold my own with the dad jokes here. All right, everyone. Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, from foundational concepts to the sophisticated strategies to help investors grow wealth with confidence. I'm Jared Chum, Head of Investor Relations here at Focus Capital.
I'm Chad Sheeler, founder of Focus Capital.
Today we're going to be covering a classification system that comes up constantly in real estate. So Class A, B, and C properties. On the surface, it sounds pretty simple, obviously ABCs, but how investors use this framework to evaluate risk, return, and strategies where things get more nuanced. So let's, like we always do, take a broader look at this. What does Class A, B, and C actually mean so we can establish a baseline? How are these classifications defined?
Yeah, they're normally defined primarily by the vintage of the property, when it was built, the year built. So Class A, let's say it lasts within the last 10 years, maybe 15 years. Class B, let's call it, this is year 2026, so maybe between years 1990 and 2010, for example. And then Class C would be the older properties, primarily.
And so if people don't even want to do the maths, I think the easiest way for investors to kind of think about it is Class A is newer construction. So they shouldn't have had any remodels or anything like that. Newer construction, whether it's like new as in yesterday or newish, like especially when they're used to shopping for residential homes, you can think that, hey, this is a newer build. If something was built in 2020, I still consider that a new build.
It presents lower risk.
Yeah. And like you said, typically within the last 10 to 20 years, premium finishes, institutional qualities, amenities, usually in high demand submarkets, and it attracts typically higher income tenants and commands higher rents, but also trades at lower cap rates. Class B, like you said, typically 20 to 30 years old, mid-tier quality, as this name suggests, functional, maybe not as luxurious, but definitely, old, reliable. I would say that Class B may have some dated interiors or deferred maintenance, and attracts some middle income workforce tenants. And often Class B is usually where investors and operators target value add strategies.
Yeah,
would that be fair to say?
Yeah, typically.
And then expanding on the Class C definition, it, like you said, older vintage, more dated condition, located in maybe potentially less desirable submarkets.
Yep.
Lower, which means
tenant quality is lower.
Yeah,
probably
lower rents, which then economically, attracts a more sensitive tenant base, like you said. Which means that there needs to be a higher management intensity, I would say.
Yep.
And then it carries more operational and credit risk. So I think these are relative classifications, but that's a pretty general description of them.
Yeah.
A Class A property in the secondary market might look very differently, for example, than a Class A property in a major gateway city. So, and they can still both be Class A. We kind of started to get into this, but how does class affect risk and return? You started on this. So how should investors think about risk and return trade-off across the three classes?
Yeah, I mean, normally the risk levels should decrease the higher in class you go. So normally A class or Class A should be lower risk. Class B is moderate, and Class C should be higher risk. Now, there's also times where if you're chasing yields, sometimes older properties give you a lot better yields. You have to weigh the risk on your own, on what's going to take to get those yields.
Yeah. So one thing that I mentioned in our general discussion in the first question was compressed cap rates. And so Class A assets generally tend to trade at compressed cap rates, which means lower initial yields. So like you were saying, if you're looking for a higher yield, then just because there's less risk in a Class A property doesn't mean that is the product that fits your strategy. I would say Class A, from an IR perspective, assets, they attract institutional buyers that benefit from liquidity. They tend to be more resilient during economic contractions in terms of occupancy. And then the downside is that rent growth is potentially pretty limited because of that newer asset. You're already at the top of the market there.
Well, something to consider as well is like tenants are in a Class A asset right now. Where are they going from there? They're going to go buy a home.
Yeah.
People in a Class B asset, they can upgrade to Class A and then upgrade to their house.
Yeah, that's a great point. Speaking of Class B, I think that this is where many experienced operators probably spend most of their time. It offers a blend of, like you were saying, stability and upside. So the tenant base is durable. The renovation potential is meaningful, and the entry pricing is more favorable than Class A typically when we're putting out offers. And that's the backbone of most value add strategies.
Yeah, no, I agree with that too. And Class B is, like you said, I shouldn't say it's the ideal, but it's the one most people go to because whether you're in a downturn or an upswing in the market, if people are in the Class B and there's a downturn, they can go to people from the Class A go to Class B, right? Mm-hmm. If there's an upswing in the market, people from the Class C go up to the Class B. Yeah. So you've always got a place to serve all those residents.
Yeah, and then Class C shouldn't be counted out, but it is something to kind of pay attention to when it comes to the fact that it does require typically the most active management and carries the most execution risk. But for experienced operators in the right markets, it can generate strong cash-on-cash returns. Yeah. But the challenge is that it's also the most sensitive, like you were saying, to economic cycles that require deep operational expertise, given that credit risk, economically sensitive tenants, it just is all type of that Class C package.
Yeah, I'll agree with you on that. Class C has been the most time and labor intensive for us to manage in the past, our previous Class C class assets. And you've got higher eviction rating or occurrences, right? Higher delinquency. It just takes a lot more to manage the tenant type. But if you're going to do those, there can be some great yields. You're going to bake it into your model and make sure you have a good management team in place.
Here's an easy short answer question, but obviously merits a longer explanation. I want to challenge a bit of the framework here. So does class alone determine investment quality? For example, is a Class A property always a better investment than a Class B property?
Not at all, because there's so many assumptions, so many variables. Like you can have a Class A property that looks beautiful on paper, great location, great business plan, but they overpaid for it going into it, and they have assumptions that are off the charts, and you probably won't ever hit those numbers. So it's all the assumptions too.
Yeah, like you said, I mean, class is a descriptor of the asset, but not a verdict on the investment. What class tells you is what type of management intensity to expect. I feel like that's what it's mostly indicative. That's good. And what tenant risk profile you're underwriting, and roughly where the asset sits in the market. But outside of that, it doesn't tell you if the deal is priced correctly, whether the operator has the right skills or not, or whether the market will even support the thesis that the operator has. And so I think it is indicative of certain things, but it's not the most indicative from an investor's perspective.
Yeah, I agree.
How does asset class interact with market class? So let's layer in that market dimension. How does the market context change how you interpret a property's class? We had mentioned this slightly in the beginning about a Class A property that's in a gateway city versus, in a less inhabited submarket.
Yeah, I think the market would be a secondary factor looking at class. Yeah, the type of the market, in fact, impacts that as well. Like if you have a tertiary market, it's more of a B class market. If you have markets that have very maybe employment decrease, you've got population decrease, like that may be a lower class market. So that's something to look for as well.
Yeah, so if we think about it from as a matrix, asset quality relative to market quality. The strongest risk-adjusted opportunities are often found in Class B assets in Class A markets.
Exactly.
So workforce housing and, like you said, high-cost supply-constrained cities is a classic example of this. We have something in our portfolio that's like that. I would also say that even though Class A is typically assumed to be less risky, you also have to make sure that you're evaluating the market class together, because a Class A property in a market with declining demand fundamentals is technically a higher risk investment than a Class B property in a strong growing market with high barriers to new supply, in my opinion.
Yeah.
What does class mean for passive investors specifically? So we talked about what you should look at and what class defines. But if someone is evaluating a passive investment, how should they use asset class? Again, we'll use market in there as well as part of their due diligence.
Well, again, it goes back to not only just the risk, but like the intensity of the labor and the management of the property. So if you're someone who wants to get into an investment to where you want to have a lot less reliance on the business plan execution by the operator, then maybe Class A is a better fit for you as long as you agree with their assumptions.
Yeah.
If you're an investor who is completely fine, you trust the operator's abilities because of their track record to execute the business plan, maybe it's a value add strategy and you're okay with Class B and Class C, you don't care about the looks, you've married the spreadsheet, so to speak, not the looks of the property, and you believe in the yields and their business plan, then go with that. It all depends on what the fit is for your investment strategy.
Yeah, I think that one thing is it all goes back to A, your investment strategy, and B, the operator's expertise. The class tells you what type of risks are most relevant, but it's the operator's job to demonstrate that they have the expertise to manage those specific risks. Yep. Because I'm sure there's a bunch of firms out there that their bread and butter are Class C, properties, and they are focused on that higher yield, which the deal wouldn't exist in a Class A property. Even though that's less management intensive, maybe they're making, their whole investment thesis is on the fact that they have that management expertise. So First, knowing where your thesis is risk-wise and investment-wise, also the amounts that you're looking to invest with, and then second, evaluating the operator, what their expertise is in, because if a solo Class A operator sponsor comes to you all of a sudden with a Class C property, it's their first time doing that, and they've only operated Class A properties in high markets, it's something to ask questions about, because you could trust that operator, but they don't have the expertise to manage a completely different asset.
By the same token, if you have an operator who's in only Class C so far and they go at a Class A, I probably trust them more to be able to execute on that business plan than the reverse of a Class A operator only to do Class C. Both are probably capable, right? It's just which one has more experience in that the heavier load of work.
I would trust them on an operational level, but then I also want to see what numbers they're going to give me as an investor, because if they think that they're going to get the same yield from a Class A property that they did from the Class C projects, then that's going to be something that I'm like, wait, then why haven't we been doing just Class A from a risk perspective? But B, there's almost no feasible way for you to be able to match those two things because of they're already at a premium. They're already in a high market. They usually have higher occupancy. And so there's not any of those strategies that work in a Class C property that can copy paste into a Class A property. So that's where I would be more cautious if a solo Class C operator all of a sudden starts to look at Class A properties.
Yeah.
How do you think about class selection here at Focus Capital? Where does Focus Capital typically focus and why?
Typically, our focus has been Class B properties mostly. We've also have part of our thesis is also Core Plus, which would be Class A properties. And more recently, we've done Class C in the past, several of those, actually quite a few, and we've done well with those. There are some Class C properties now that present some solid yields, and there's a case to be made to where those could be a really good investment strategy if done the right way in the right markets. Maybe they're going to create more density with other areas where our own properties in, where it'd be a larger management play there. But I would say that we're going to say certain classes are a no-go. For sure, the Class B and Class A, no problem at all. We're great at doing those. Class C, a little more of a microscope on those properties, make sure they're the right ones, but there could be some good ones there.
Yeah. I think from an IR perspective, it goes back to that first step for investors, which is, what is your investment thesis? Are you looking for another stream of revenue, so you're more focused on that cash on cash return? Or are you like, I make enough in my W-2 or my active income streams right now, that's not what I'm wanting. I'm wanting more of the capital preservation, the larger upside, because like you said, if you're playing the yield game, typically if you have higher cash on cash returns, because that's coming straight from operational cash flow, there's typically a lower IRR. They're inversely correlated. As cash on cash goes up, as equity multiples go up, IRR goes down, and that's fine. But if you're wanting, that's why a lot of people that are wanting a bigger upside invest in only development deals. They're like, I'm not worried about the cash on front, which is great because zero occupancy means zero cash on cash.
Yeah.
In the beginning.
Zero distributions.
Yeah, zero distributions. But the IRR might be closer to like an 18 versus what you were saying earlier, a core plus deal, 13 to 14%, good IRR. You're gonna have a higher cash on cash return sooner because those Class A markets are already driving high occupancy rates. And so one thing that Chad had mentioned when we are looking at pro forma and occupancy and evaluating those kinds of statistics is if you have a vacancy of less than 5%, it's usually indicative to the operator that you can raise rents. You don't want to be at 100% occupancy for a long period of time. That's a mistake that I think a lot of investors make is if like, why aren't we trending towards 100%? Why aren't we at 100% all the time? And it's like, you don't want to be at 100% all the time. Because,
you gotta raise rents.
Yeah, you gotta raise rents. I would say that sweet spot is right between 90, maybe probably 93 to 95%. Having a vacancy rate of anywhere between 5 and 7% is still a healthy rate.
There's a balance there. Plus, you're also trying to balance the odds of you getting a renewal increase against the vacancy you may have with and turnover costs as well. So there's a matrix there to figure out the right area to be in.
Yeah. So in summation, Class A, B, and C are useful shorthand, but the real question isn't what class is it. It's does the operator understand the specific risk of this asset or class in this market at this price? And that's a more important conversation than is it a Class A or Class B or Class C property. So understanding the property's classes gives you the framework to ask better questions, and better questions lead to better investment decisions.
Yeah, love it, man.
Perfect.
Class A all the way.
See you next week.
Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.